Wait, China just reduced its US Treasury holdings to $759 billion. That's down from $1.3 trillion in 2013. Japan's selling, the UK's selling. And foreign ownership of US debt has collapsed from 50% to barely 30% in a decade. By the end of this video, you'll understand why the dollar could lose its reserve currency status within 18 months. And why that timeline isn't speculation, it's mathematics accelerated by geopolitics. But first, you need to see what's happening right now. Because what's happening now has never happened before in the 80-year history of dollar dominance. Right now, this second, the US national debt exceeds $36 trillion. That's 120% of GDP and climbing. Foreign holdings of US Treasuries peaked at 50% of outstanding debt in 2014. Today, it's below 30%. The dollar's share of global reserves has dropped from 73% in 2001 to 58% in 2024, the lowest level in 30 years. And here's what they're not telling you. This isn't diversification, this is flight. And the people running have inside information you don't. Let me show you something that changes everything. There are 4 phases to every reserve currency collapse in recorded history. Once you see this pattern, you can't unsee it. And we're in phase 3 right now. Phase 1. Dominance and trust. The currency is backed by the world's largest economy, strongest military, and deepest financial markets. Foreign nations willingly hold the currency because it's just the safest store of value and the most liquid means of exchange. This is stability. This is confidence. This is what the dollar enjoyed from 1944 to 2008. Phase 2. Abuse and overextension. The issuing nation exploits its privilege. It prints money to fund wars, welfare, and deficits that would bankrupt any other country. Foreign creditors grow nervous but have no alternative. They keep buying the debt but more slowly. They start asking questions. This is where we were from 2008 to 2020. Quantitative easing, 0 interest rates, $5 trillion in money printing. And foreign central banks watched and waited. Phase 3. The silent exit. Foreign creditors stop accumulating. They start reducing holdings. Quietly at first. Then deliberately. They don't announce it. They don't crash the market. They just stop buying. And slowly, methodically, they sell. This is where we are now. Right now. This second. And the data proves it. Phase 4. The collapse. The market realizes what's happening. Yields spike. The currency crashes. Inflation explodes. The government responds with more printing, which accelerates the collapse. Within 18 to 24 months, the currency loses reserve status. Those holding the currency are destroyed. Those who saw it coming survive. Let me prove to you that we're in phase 3. And that phase 4 is closer than anyone in power will admit. China's strategic withdrawal. In November 2013, China held $1.317 trillion in US Treasury securities. It was the largest foreign holder of US debt. That position represented power, leverage, influence over the global financial system. Today, China holds $759 billion. That's a reduction of $558 billion. A 42% decline in just over a decade. But the pattern reveals everything. China didn't dump overnight. They did it systematically, deliberately, like someone who knows the building is on fire but doesn't want to start a stampede. Look at the timeline. In 2022, China divested $173 billion in US Treasuries. In 2023, another $51 billion. In 2024, $57 billion more. That's 9 months of declines in 2024 alone. By September 2025, China's holdings hit $700.5 billion, the lowest since October 2008, right after the financial crisis. That's not coincidence, that's calculation. And they're not alone. The global exodus. No one's talking about Japan. The world's largest holder of US Treasuries at $1.06 trillion has been selling since November 2024. They reduced holdings by $27 billion in December alone. After years of being America's most loyal creditor, they're walking away. The United Kingdom, once the second largest holder, dropped from $904 billion in August 2025 to $865 billion in September, then down to $809 billion. That's $95 billion in 3 months. Foreign official holdings of US Treasuries fell to $2.87 trillion in January 2025, the lowest level since March 2020, when Treasury markets froze during the COVID panic. Let that sink in. Foreign governments now hold fewer US Treasuries than they did during a once-in-a-century pandemic crisis. And they're still selling. Since the November 2024 election, foreign officials have sold $78 billion in US Treasuries. Not over years. In 2 months, and here's the part that should terrify you. While foreigners sell, the Federal Reserve is also selling through quantitative tightening. The Fed's balance sheet has dropped from over $8 trillion to under $7 trillion. So who's buying? Domestic investors. American banks. Insurance companies, pension funds. They've been forced to pick up the slack. But they're not buying because treasuries are attractive. They're buying because they have no choice. And that dynamic cannot last. The dollar's declining dominance. The dollar's share of global foreign exchange reserves stood at 73% in 2001. By 2015, it had fallen to 66%. Today, it sits at 58%, the lowest since 1995. Over the past decade, the dollar has lost 8 percentage points of market share. If this pace continues, the dollar share will fall below 50% by 2034. But Phase 4 accelerations don't follow linear trends. They follow exponential ones. The euro holds steady at 20% of reserves. It's not taking market share from the dollar. Instead, the dollar is losing to what the IMF calls non-traditional reserve currencies, the Australian dollar, Canadian dollar, Chinese renminbi, and others. But the real story is gold. Central banks have been accumulating gold at the highest pace in decades. China added gold reserves for 18 consecutive months through 2024. Russia, Turkey, India all buying gold aggressively. When you include gold in global reserve calculations, the dollar's share drops from 58% to just 48%, below 50%. The psychological threshold has already been crossed. The BRICS, alternative Brazil, Russia, India, China, South Africa, Egypt, Ethiopia, Iran, United Arab Emirates, Indonesia. These 10 nations represent 45% of the world's population and 35% of global GDP. At the 2024 BRICS summit in Kazan, Russia, Vladimir Putin held up a prototype BRICS banknote. The symbolism was deliberate. The message was clear. They're building an alternative to the dollar system. The BRICS nations are already settling nearly 50% of their intra-block trade in local currencies, bypassing the dollar entirely. China and Russia conduct most bilateral trade in yuan and rubles. Brazil and China signed a yuan-real trade settlement agreement. India purchases Russian oil in rupees. They're not planning to replace the dollar with a single BRICS currency that's the Western narrative to downplay the threat. Instead, they're building a network of bilateral trade agreements, swap lines, and payment systems that simply don't need dollars. China's cross-border interbank payment system, CIPS, now connects 4,800 banks across 185 countries. It's a direct alternative to SWIFT, the Western-controlled payment network. And it's growing rapidly. The BRICS New Development Bank issues loans in local currencies, allowing member states to borrow without taking on dollar-denominated debt. This breaks the dollar's structural advantage in international finance. Donald Trump threatened 100% tariffs on any BRICS nation that challenges dollar supremacy. That's not the behavior of a confident hegemon. That's desperation. That's an admission that the threat is real. The bond market breaking, here's where it gets terrifying. Since September 18, 2024, the Federal Reserve has cut interest rates by 100 basis points. Normally, when the Fed cuts rates, long-term Treasury yields should fall. That's how it's supposed to work. Instead, the 10-year Treasury yield has risen by 100 basis points over the same period. This is called the reverse conundrum, and it's flashing code red. Why? Because foreign demand has evaporated. When the Fed cuts rates and yields rise anyway, it means the market is demanding a higher risk premium. It means investors don't trust the debt. It means they see default risk or inflation risk or both. The term premium on US Treasuries, the extra yield investors demand for holding long-term debt, has spiked to levels not seen since before the 2008 crisis. The market is repricing US sovereign risk in real time, and domestic buyers are reaching their limits. US commercial banks now hold 55% of treasuries, up from 30% a decade ago. They're becoming dangerously concentrated in a single asset class. When that position becomes too large, they'll have to stop buying. And then what? The fiscal death spiral. The US government now pays over $1 trillion annually in interest on the national debt. That's more than the defense budget. More than Medicare. And it's accelerating. At current debt levels and interest rates, interest costs will exceed $1.5 trillion by 2026. That's 20% of all federal revenue just to service existing debt, not to pay it down, just to pay the interest. The deficit in fiscal 2023 exceeded $1.7 trillion. In 2024, similar. Every year, the government borrows $1.50 to $2 trillion more. That debt needs buyers. And the traditional buyers are walking away. Here's the trap. If the Fed raises rates to defend the dollar or fight inflation, interest costs explode and the deficit widens. If the Fed lowers rates or restarts money printing, inflation accelerates and foreign creditors flee faster. There is no good option. Every path leads to currency debasement. And that's exactly what China, Russia, and other creditor nations see. That's why they're selling now, before the crisis becomes obvious to everyone else. The 18-month calculation. Why 18 months? Why is that the timeline for potential dollar crisis? Because Phase 4 accelerations happen faster than Phase 3 exits. The silent withdrawal can take a decade. The panic collapse takes 18 to 24 months. Look at the British pound. It took 40 years to decline from reserve currency to regional currency 1914 to 1956. But the collapse phase, from dominant reserve to clearly secondary, happened between 1939 and 1947. 8 years of war and crisis. The dollar has more structural advantages than the pound ever did. But it also has more structural liabilities. The debt is unprecedented. The printing is unprecedented. The geopolitical challenges are stronger than any Britain faced. Here's the math. If foreign treasury holdings decline at the current pace of $300 to $400 billion per year, and if the Fed maintains quantitative tightening at $60 to $80 billion per month, and if the deficit stays above $1.5 trillion annually, the math breaks within 18 months. By mid-2026, domestic demand will be saturated. Banks will be overweight treasuries. Insurance companies will hit regulatory limits. And the government will still need to sell another $2 trillion in debt. When that moment comes, yields will spike. Not by 50 basis points, by 300 to 500 basis points. Because the market will demand compensation for financing a government that might not be able to pay. At 8% to 10% yields on 10-year treasuries, interest costs alone would consume 40% to 50% of federal revenue. The government would face a choice: default on obligations or print money to cover them. Either choice triggers Phase 4. Default destroys the dollar's safe haven status instantly. Printing accelerates de-dollarization as inflation erodes purchasing power. The pattern is completing. This is not a prediction. This is not a theory. This is a description of a pattern that has completed multiple times across different civilizations and different eras. The British pound lost reserve status between 1914 and 1956. The French franc before that. The Dutch guilder before that. The Spanish peso. The Portuguese real. Every dominant currency eventually faces the same fate. Overextension, abuse of privilege, loss of creditor confidence, and collapse. The dollar is not exempt. American exceptionalism does not override mathematics. And the mathematics are unforgiving. China holds $759 billion in treasuries today. At any moment, they could announce a policy to reduce holdings to $500 billion within 12 months. That announcement alone would trigger a crisis. Yields would spike. The dollar would plunge. Other foreign holders would race for the exits. They haven't done it yet because it would hurt them too. They'd take losses on their existing holdings. But as their position shrinks, so does their exposure. At $500 billion, the damage from a dollar crisis becomes manageable. At $300 billion, it becomes negligible. We're watching them position for a post-dollar world in real time. And they're not hiding it. What no one's telling you, the mainstream financial media won't cover this story honestly. They'll dismiss it as conspiracy theory. They'll say foreign holdings fluctuate all the time. They'll point to the dollar's recent strength as proof of stability, but they're either ignorant or lying. The dollar's recent strength is not a sign of confidence. It's a sign of global crisis. When the world faces turmoil, capital flows to the US by default. Not because the US is strong, but because there's nowhere else to go. Yet. The moment a credible alternative emerges, that dynamic reverses. And the BRICS nations are building that alternative right now. Not perfectly, not quickly, but deliberately. They don't need to create a single currency that replaces the dollar overnight. They just need to create enough optionality that the dollar's monopoly ends. Once that monopoly is broken, the unraveling accelerates. The protection you need now, most people won't understand this until it's too late. They'll watch yields spike and blame inflation. They'll see the dollar fall and blame tariffs. They'll feel their purchasing power erode and blame corporations. And when the reserve currency status is lost, they'll be shocked, confused, unprepared, and financially destroyed. Don't be most people. The strategy is not complicated. You hold assets that survive reserve currency transitions. Physical gold, silver, real assets with intrinsic value, commodities, productive land, businesses that produce things people need regardless of the currency. You diversify out of dollar-denominated paper. Not entirely because you still live in a dollar economy, but you reduce concentration. You hedge. You understand that wealth is not measured in the currency of a dying system. You stop thinking in dollars and start thinking in ounces, in acres, and barrels, and things. You stop trusting that central banks and governments will protect you. They won't. They'll protect themselves. You're on your own. The timeline is now. The great treasury dump is not coming. It's happening. China's holdings are down 42% from peak. Japan's selling. The UK's selling. Foreign official holdings are at 2020 crisis levels, and they're still falling. The dollar's reserve share has dropped 15 percentage points in 23 years. The pace is accelerating, not slowing. The BRICS alternative is being built in real time. The bond market is breaking yields rising while the Fed cuts. Every indicator is flashing red. Every pattern from history is repeating. Every warning sign that preceded previous reserve currency collapses is visible right now. The question isn't if the dollar loses reserve status. The question is when. And whether you're positioned to survive what comes next. 18 months is the mathematical timeline when current trends reach critical mass. It could happen sooner if a catalyst emerges, a geopolitical shock, a debt crisis, a banking panic. It could take slightly longer if governments intervene aggressively. But the direction is set, the pattern is completing. And the greatest monetary reset since World War II is already in motion. If you want to understand how we got here, how the dollar system was built, and why it's now failing, you need to keep watching. If you want to know the specific assets to hold, the mistakes to avoid, the timeline markers to watch, subscribe now. This channel exists to decode the pattern, to show you what's hidden in plain sight, to prepare you for what's coming. The treasury dump is not a future event. It's happening right now beneath the surface. And when it breaks into mainstream awareness, it will be too late to prepare. The exits will be blocked. The alternatives will be expensive. The damage will be done. Don't wait for permission. Don't wait for CNBC to tell you it's real. China has already told you what they think. They're selling $50 to $100 billion per year. They've reduced their position by 42% from peak. They're preparing for reset. The question is, are you?